Great. Hope you're doing well. Happy August. I wanted to get this market update out and let everybody know what's going on in the wonderful world of real estate these days. We just concluded last week a conference in Jackson Hole, Wyoming, where we saw Jerome Powell speak Friday, basically sticking to his target rate of 2% for inflation. Some economists believe that may be a little bit extreme. We may never get there, or if we do, we may blow right past that goal, well lower than that, possibly into the negative numbers again. So we'll continue to watch what happens with inflation. We saw U.S. Treasury bonds, 10-year U.S. Treasury bonds soar up to 4.34%, which is the highest rate we've seen, or highest yield we've seen on those 10-year U.S. Treasury bonds since 2007. That has a lot to do with the U.S. Federal Reserve Bank issuing a record $1.1 trillion in bonds this quarter, which is the most in bonds we've ever issued in a quarter. We've also seen a record number of bonds issued by corporations globally, somewhere to the tune of $2 trillion. So lots of bonds, lots of competition for that bond investor. And in order to attract those investors, those yields get pushed up. So currently we're sitting around a tenth of a point under that. We're sitting around 4.24. So bonds are starting to come back. Interest rates are coming back. As a result of those crazy high bond rates, we saw mortgage interest rates soar well into the sevens a couple weeks ago. We started to come back a little bit. We're slowly kind of trying to come back from those rates in the mid sevens, low sevens. So we'll keep an eye there. We do have a Fed meeting coming up. The next Fed meeting is September 20th. Right now, the market's pricing in about a 15% chance of a rate increase at that next Fed meeting. The only thing keeping rate decreases off or rate cuts off would be a jobs report that came in below expectations, well below expectations. We need unemployment to come up really before rates dip down or we start seeing rate cuts again. So moving right on, inventory crazy low. Obviously, these higher interest rates have slowed the interest of some prospective buyers, but we have far less properties available for purchase than we do buyers looking to purchase those properties. So more buyers than sellers is keeping home prices up, keeping appreciation level or probably around 3%, 3.4% a year. Depends on your market. That's expected to continue for the next 3 to 5 years. About 18% of the predictions that I saw over the next 5 years cumulatively. So we'll see what happens there. Inventory in 2023 as of July was 647,000 homes. Prior to the pandemic in 2019, we had 1.24 million homes available for sale. So that's pushing sellers or pushing buyers away from purchasing existing homes because there just aren't that many available to purchase. And we're seeing that shift go into new home sales, so new builds. If the existing sellers, the people that own existing homes, are not willing to sell, willing to depart with their property because of their record low interest rates, certainly new home builders are more than willing to accommodate. So we've seen the number of new homes sold soar. We're up 4.4% month over month and up 31.5% year over year from last July. So thought that was interesting to see. Always, there's those of you out there thinking this is a flash in the pan. We've been saying this I've been hearing this honestly for about 15 years that we're headed towards another crash. But especially in the last few years, we're headed towards another crash. These crazy rates of appreciation that we saw can't continue, and they're not continuing. We saw 21% appreciation during 2020, 2021, even somewhat in 2022. Currently, we're sitting about 3%, 3.5% appreciation. That's expected to continue. But for those of you thinking that we're going to see the market crash, I included a chart to show the number or the percentage of homeowners currently delinquent 90 plus days on their mortgage. So you can see we're lower than we have been in the last 20 years, even well before the market crash in 2007, 2008, even going back to 2003. You can see that the number of current mortgage holders, 90 days plus, is about a third, maybe even half of those that were 90 days late in 2003. So we'll see what happens. Again, jobs reports. We need jobs reports to come out showing that unemployment is on the rise. We should see ADP report on Wednesday. We see the BLS report on Friday of this week. We'll see what happens with those. Realistically, I don't think we're going to see any rate cuts as far as Fed Reserve rate cuts until probably May of 2024. So we're just looking at, economists are looking at the rate of savings accounts and the amount of credit card debt that is growing. Savings accounts are dwindling. So as those savings accounts come down, as those credit card debts grow, people should start to slow spending, which will bring inflation down even more. So we'll keep an eye on things. Let me know your thoughts. Let me know your questions. Look forward to hearing from you. Have a great day. Appreciate you checking this out. And I will talk to you very soon. Have a great day.